Now, Martin here, he headed an expert group last year assessing how climate change, climate policy, and the green shift may affect the Norwegian Government Pension Fund Global, also known as the Norwegian Oil Fund. Their advice was for the fund to strengthen its work on climate risk. Now, I wonder how that piece of advice is put into practice by the GPFG, one of the world's largest funds. It owns shares in more than 9,000 companies worldwide, and it executes its ownership actively, according to our next speaker. Carine Smith Ihenacho is Chief Governance and Compliance Officer at Norges Bank Investment Management. She is responsible for, amongst others, the fund's responsible investment activities and its operational risk. She's joining us virtually this morning, and I think I can say now, nice to see you, Carine. And I would like to know, as an active owner, to what extent and how are you at the Norwegian Oil Fund pushing or pulling the companies towards a sustainable path? And with that, I'm going to leave the digital floor to you, and you also will, of course, get a nice warm round of applause. Carine Smith Ihenacho, take it away.
Thank you, Ruth, and good morning to you all. And I'll start like Martin did to say, and I 100% agree with him, that the shift in finance is for real. And I will talk about what we in NBIM, also called the Oil Fund, are doing to manage climate risk. We are a large and diversified investor, and long-term value creation for the fund depends on the world's economic, social, and environmental future. And as you see here, more than 70% of the fund is invested in equities. So that means that we own shares in more than 9,000 companies in over 70 countries. And this means that we own a small part of almost every listed company in the world. So our long-term success depends on the success of all the companies we invest in, and through that, the global economy. And the company's long-term success will depend on how well they manage climate risk. And as a shareholder, we have the right to influence these companies, and we use this right actively. Our starting point is that we are affected by climate risk. We are an investor in the climate transition. And on this chart, you can see the share of our equity portfolio's market value based on MSCI's 5 categories on climate transition risk. And as you see here, 15% of our portfolio is in companies that need to transition in the way they operate or what they produce. And oil and gas companies, for example, fall in the latter category. And we also see that 6% of our portfolio is in companies that contribute to the climate transition, such as low carbon energy production. And it is with that in mind, we address climate risk as an active long-term investor. And active ownership starts with setting clear expectations. Our starting point is that the boards should have oversight of the climate-related risks and opportunities faced by the companies and account for associated outcomes. And that is specified in a document you see a picture of here. And more specifically, we want to see companies adopting clear climate plans that consider the goals of the Paris Agreement. And this means net zero by 2050. And we've had these expectations for over a decade. We are constantly updating them to ensure that they're both ambitious and in line with international developments. To make good investment and ownership decisions, it's important to know our companies well. Simply put, engagement means speaking with the companies. And this is one of the most effective ways in which we can convey our views and influence companies, and also learn more about them. And last year, we discussed climate change issues in almost 800 company meetings. This represents 35% of the fund's net asset value. So in other words, we raise climate risk with investments worth more than 3,000 billion Norwegian kroner last year. That's something. So what do we talk about? Common issues we raise are emission targets, energy transition strategies, governance, capital allocation. And through these discussions, we can identify the climate change winners and those that are further behind the curve, exactly what Martin talked about. Who will be the winners in the transition? But do these discussions give any results? So every year we measure around 1,500 companies' public reporting on climate change. And based on this, we see that companies are taking actions in line with our expectations. And then you may ask, is that because of our work? Well, companies are of course exposed to pressure from numerous stakeholders, other investors, customers, employees, policymakers, and others that may advocate for the same changes as we do. But we do believe that our engagement has contributed to some of these developments. And we have some measurements that support this. We see in our assessments that the companies we have engaged with on climate change improved more than companies we did not engage with. And for us who work with ownership every day, this is encouraging. Other areas of our work have even clearer outcomes. As a minority shareholder in more than 9,000 companies, we vote on around 12,000 resolutions annually. And climate is not a traditional voting topic, but we see more and more opportunities where we can use our voting rights to promote our views on climate. In some markets, shareholders can present proposals at the general meeting. And in the first half of this year, we supported 19 shareholder proposals on climate. And we see over the years, more and more of these proposals win majority support. And just to take an example, that's Chevron, where Scope 3 reporting proposal passed for the first time with our support. And subsequently, Chevron started with such reporting. And we also increasingly vote against the re-election of a director for climate-related reasons. One example is Huaxin Cement, a Chinese cement company, which does not disclose their climate strategy or emissions. And we also see more and more that companies put their own climate transition plans up to a shareholder vote. And we supported 15 transition plans, such as HSBC. Their plans are in line with our climate change expectations, setting short, medium, and long-term climate targets. It is as an owner we can influence companies. We want to be an owner in the climate transitions. But sometimes we decide to divest, where we believe that the company's business model just is not sustainable and ownership will just not work. And since 2012, we have made more than 170 divestments of companies for climate-related reasons. And interestingly, this has made money too. These divestments have resulted in higher returns for the fund. So just to sum up, we believe that ownership works and it will help us move towards net zero in 2050. But we are constantly evaluating work and we'll step it up. We will sharpen our expectations towards companies. We will increasingly vote against board members who do not manage climate risk well, and we will increasingly report on the results of our work. Thank you.